Welcome back to the second video with tax expert Dirk, all about taxes and investment. Let's start with the first question. Many people invest in ETFs here with one of these online brokers in Germany, or sometimes even with brokers outside of Germany. Generally speaking, how are ETFs in brokers taxed?
I mean, broker is an agent, right? So he only basically sells your products, but then you buy it. You buy ETFs, you buy shares, and you get income from that. And that is then hold at the banking institution. So you have a depot there where you earn your money, right? So that means irrespective of what kind of broker you use, the size of is where is your investment and how do you get then the profits out from this investment, and that has then to be taxed accordingly. I mean, if you are, we had it in the last video. So if you are a resident of Germany, it's taxable in Germany according then basically to the German rules. And usually, if it's within a banking institution, they issue then the respective income certificate, which you then basically have to use within the tax return. And if it's from a German institution, then they also are required to conduct the respective tax withholding from your profits there. The other point is that's also what we discussed in the other video. So if you have invested in foreign investment funds, foreign mutual funds, there's a disadvantageous taxation in Germany. I would not recommend to do that, at least if they are not registered within the EU. Right, within the EU, the rules are aligned, so that does work. But any other mutual funds, stay away from it.
Mm-hmm. Which are mostly the ones that are domiciled in Germany, Ireland, or Luxembourg. Most of them, yeah. Many people feel that they pay way too much taxes here in Germany, myself included, by the way. I really hate I hate it so much, words can't describe it. And at the same time, interest rates have been near zero over the last couple of years. Now you get a little bit, but still quite less, especially given that inflation is on a record high. So the question that we get asked a lot is, how can one invest with a higher interest rate than zero and get tax benefits at the same time to lower their tax bill?
I mean, what I always say is all taxes which you saved, you paid for it upfront. So there is no tax reduction for nothing, right? So you have to invest in order to get the deduction. So that's the point. So therefore, it's very important to decide, does the investment makes economical sense for me, right? And only if the answer is yes, then I would invest in save taxes. Not invest just in order to save taxes. By the way, there were these models in Germany. They were basically not accepted by the German authorities because they said the only reason of the investment is save taxes, and that's not accepted.
Okay.
Right, and a lot of these investments they also went bankrupt, and so again, decisive is the economical purpose. Does it make sense? So, and there are basically two investments where I would say, yeah, it does make sense, because you build up property or income for the future, and that one is pensions, and the second one is investing into real estate. Right? But also with these ones, you have to be careful in what kind of product you invest, right? So, and I mean, if we are talking about pensions, right? So in Germany, basically, we have a 3-layer system, right? So you have the statutory pension scheme, so gesetzliche Rentenversicherung, in which basically every employee is, except that's kind of similar are the professional pension systems, so like berufliche Versorgungswerke. So for lawyers, architects, tax advisors, medicine, and so basically for freelancers, right? So Freiberufler. So and you have Rürup, which provides basically the same, but from a tax point of view, even more, right? So and that is basically was created for self-employed people.
I have one, for example, because I don't pay into the German public pension.
So, right? But also people paying into a public pension, they are allowed to invest into Rürup because Rürup has higher deductions. Or you can pay more into it and still get a pension deduction. Let's put it this way, right? So then the second layer are basically company pension schemes, like Direktversicherung or Pensionskasse or pension cashier, so just or Riester, and then there's the private pensions. Right? So and if we are talking about Europe, as I said, it's for self-employed, freelancers, and higher earners. They benefit the most of it, right? So the tax deduction you can get from Europe is if you pay. So it's for single persons. Right now, it's a little bit more than 26,000 euros, which is then deductible for tax purposes, right? For married individuals, this amount doubles, right?
Which is a lot.
Which is a lot, right? And the good thing is that we had a reform in the whole pension system in Germany, right? Up to 22, only part of it was deductible for tax purposes, right? That deductible amount increased year by year, right? But with a tax reform this year, since 23, we are allowed to deduct 100% of your pension contributions up to these maximum amounts, right? So, preconditions, of course, there are a couple, so which has to be fulfilled. I mean, that's always right. So, because these pension have to serve a purpose, then the conditions have to be fulfilled. So that's one. It should be a contract concluded after 24. It has to foresee a payment of a monthly constant or increasing life annuity.
That's why only Rürup, yeah.
Yeah, right. And it cannot start before the age of 62. It's continuous payments, right? Then, of course, you have to confirm that the data can be exchanged, so that's a data protection rule, and only concluded with an insurance company which is registered within the EU.
Very important, yeah.
Yeah. So a US insurance will not be will not qualify. So as we have a high tax deduction, and if you pay your contributions to it, then of course taxation will also, and that is at the payout. You have a full taxation at payout then.
They want the taxes at some point, yeah.
They want the taxes at some point. But here it's also, since previously you only can deduct part of it, the amount which is taxable at payout decreases or increases also, right? So in, let's say the payout in 23 would only be taxable at with 83% of it, but the maximum 100% taxable to be reached in the year 2040. So I would assume most of you would have to tax 100% of it.
Probably.
But you also have to consider depending on where you're living at that time of the pension payment, again, you have to look at the double tax treaty where this amount is taxable, right? So then and as I said, this rule is basically it's similar then to the governmental pension, so the
tax wise,
tax wise, right? But the contributions to the governmental one are limited up to a maximum, right? But this maximum is lower than the deductible amount of 26,000 for a single. So therefore, if you would like to invest, you can put up to that maximum amount other contributions into these such a rural plans, right? So then we have company pension schemes, right? So it's important to know that the employers are required to offer you that. So if you're asking for that, so they have to provide you with something. So that can be a direct insurance or pension cashier. There are also limits, right? And there are also basically preconditions to be fulfilled, right? You have one which is relatively easy. It's a direct commitment. So it's an Direktzusage. So, but that is basically if your employer says, so if you retire at the age of, let's say, 67, you get X amount pension. They accrue for it, you do not pay anything into it, and you get it. By that, to be honest, that is usually for upper management.
Yeah.
Right? So CEOs and CFOs, they usually get it on higher management. So, company pension scheme, what is important? So it has to cover at least one biometric risk, which is old age, death, invalidity, right? There has to be a connection to the employment. So it's only possible if you're employed. And you can claim the benefit if that biological event occurs. So if you get disabled or if you reach the pension age and so on. Yeah. And of course, then the biometric risk has to be covered by that. Tax-wise, if you're talking about the direct commitment, Direktzusage, only employer contribution, tax-free at the contribution level, so that's usually an accrual, right? So it's also called basically deferred compensation. There's no social security on it, and full taxation at payout, right? So, and if I say it's also a kind of deferred compensation, that is also a possibility which is offered to the upper management that they can defer part of their remuneration into such a direct commitment, but it has to be done before they are eligible to that. Right? So let's say if a bonus payment is paid out in April each year, they have to say in January, February. So if I get a bonus, I would like to have it deferred.
So that it goes directly into the direct commitment.
That it goes directly there. That is right. That is the only way to avoid the actual taxation. And then, I mean, that's basically then again a cash flow question, right? So yes, you can save the taxes on these amounts, right? And usually the assumption is that if I'm at the retirement age, I anyway earn less, and then my tax rate is anyway lower.
Yeah.
Right? So that is the ratio behind it. But you cannot use the money. The money is frozen for the next 20, 30, 40 years.
So tax-wise, it can make sense if I work now and have a relatively high tax rate. I do something that is tax deductible, because later when I'm retired and I have a lower income, I have to pay taxes, but my tax rate is probably a lot lower than it is today. Yeah. That's the idea.
That is right. So, and with the direct commitment, deferred compensation, it works up to 100% of the amount. then for the other one, so Unterstützungskasse, which is support fund or direct insurance or pension funds, there are limits, right? So the limit is basically the employer contributions are tax-free and no social security up to 8% of the threshold for pension contributions, which was 7,000 in 22, right? So it's not that much, but it's sad, right? For social security, so then the lump sum taxation is possible, so that you only can pay 25% tax on it, and then you are done with it. And then the taxation at payout basically depends on how the tax treatment was at the time it was contributed. So if you have a lump sum taxation of 25%, it is already taxed, right? Then there's no taxation. If the taxation was deferred, then of course, then you have the taxation at the first. Riester right now is under discussion. It is under discussion because they say that what you get out of it does not really make economical sense. So because the companies who offer Riester, Riester is usually capital based. There's also Wohn Riester, so that's a special rule, but mostly it's capital based. And then there are restrictions how they can invest the capital, because they have to guarantee that at least what was paid in has to be distributed to the individuals, right?
So only pension with a minimum enforced guarantee,
so but that limits them in how they invest the money, right? So and that's the discussion is, if I would do it on a private basis, you could get more out of it. So right, so that's about Riester, right? I mean, you can do it, there are tax advantages, and then you basically have to decide by yourself if it doesn't make sense, right?
So maybe if there's a family, right? So most people that, because expats love it because you get the government, you get tax benefits and government bonuses. So every adult gets 175, which is nice. But myself, for example, as someone without kids, I wouldn't get a Riester for myself. If you have 2 kids, maybe then it looks different.
Of course, then you get the child bonus as well, and then So, I mean, who is eligible for Riester? Anybody who is insured in a statutory pension scheme, and who pays a minimum contribution into this certified plan. It has to be certified plan, of course, right? 4% of the salary, up to the 4% of the contribution limit, right? So, but maximum 2,100 euros. So, you get the allowance or the bonus only pro rata if you contribute less than this amount. And then you have individuals who are indirect eligible, right? So these are basically spouses, registered partners of a direct eligible person. Of course, you have to pay the minimum contribution. This one also gets only the full contribution if the eligible partner pays the minimum contribution.
Yeah.
When filing the tax return, there will be done a beneficiary test, right? So what is more beneficial for the individual? To have the bonus payments, right? Or you get a tax deduction for the contributions plus these bonus payments. And if the tax saving from the deduction is higher than these bonus payments, then you get the tax deduction in addition, basically. Right? And at payout, then of course it's taxable because you have a tax deduction or you got.
Yeah, exactly.
Yeah. So then one important point with pensions, I have to mention that's about foreign pension schemes. Yeah. That often happens if an individual is assigned or basically comes for 3 years on a local contract and then goes back to the home country, but basically stays with the employer, then you might think about still paying into that home country pension scheme of that company. That's not a good advice because foreign plans are usually not accepted for German tax purposes.
Okay.
That means if your employer pays contributions into the plan, it's taxable. If you pay contributions, they are not tax deductible. Right? But still, at payout, they are taxable. So then you have a double
twice. Yeah.
Yeah. So stay away from it. If you move to another country, then only pay into the pension scheme of that country where you're working. Right?
Okay.
So there are a few tax treaties which basically deal with that topic, like with the US, right? In Article 18A, so there's a provision, but also here again, the acceptance is limited up to certain amounts, which are not very high, right? So usually contributions into, let's say, a 401k plan are higher than what would be accepted by the German authorities according to the double tax treaty, right? So that is, keep your eyes open on this one.
Okay, good tip.
And then the third layer, these private pensions, they usually do not fulfill the requirements as we have mentioned before, and therefore tax deduction is in a lot of cases not possible. They are also not accepted that they transfer the data to the tax authorities and so on. That's a private decision economically wise. They might be a good product, right? So that basically this pension insurance invests your money in a good way and you get a good pension out of it, right? But then since that is basically out of taxed income, then the tax treatment at payout, you have to look then at the payout where it's taxable and if only part of it is taxable and so on. Right?
Yeah. Which is where you're usually getting the tax benefits, right? In level 3, you get them in the payout phase after 62. Probably the most asked real estate question is if one should be renting or buying real estate. It's almost a religious discussion that we have within the community. And I have from a strictly financial advisor point of view, you mentioned economic sense in the question before, and I have a very strong opinion what makes sense in the economic point of view. But we want to know from your point of view, from taxes, what makes more sense, renting or buying?
Only financially looking at it, then investing, right? Because if you invest in real estate, then basically all what you have to pay for it has a influence on your tax rate, right? So, I mean, what are the differences? So, if you buy the home for yourself, for your family, there is no tax benefit, no mortgage deduction. The only tax benefit what you can get is what I said in the other video for maintenance or for craftsmen. You have to pay to repair the roof or for gardening or whatever. These are the only costs which are or will be offset against your tax liabilities, right? There is kind of a small governmental support for families to buy a home, so like Riester or a
KfW-Förderung.
interest support via a KfW and so on, and probably for climate renovation or modernizing and so on. If you invest in real estate, right, then basically first all the costs related to the purchase, like agent fee, notary, court costs, and so on, they will go into the depreciation basis for the real estate, and then you rent it out, you receive income from it, and then you can basically deduct the depreciation rate from that, and you can deduct your interest costs for the mortgage, only the interest, not the whole annuity, and any other costs which are related with renting it out, like also agent fee to get somebody,
property manager,
real estate tax, all other
insurance,
things, maintenance, and so on. So that is all deductible. And if at some point you sell that property, then it is tax-free if you had it for at least 10 years. So after 10 years sale, tax-free. So that which might be a huge benefit as well. At least it was for the past years. If you buy now, and as you know, the real estate market is kind of steady now, nobody knows will it go up or will it decrease. So then you have to see, right? But I mean, it's a personal decision. I mean, you have to think about what does it mean. So I would like to live in a house. I rent the house, and you have always the risk that the owner at some point says, I need it for my own. You have to get out of it, right? So you cannot use it as your own, right? So if you would like to have a nice garden, whatever, the kids are used to it, it's a neighborhood. So that these are all facts you have to consider also. So therefore, buying real estate, it's not just a finance decision.
Yeah,
I mean,
lifestyle
you can
decision.
basically say it's emotion or it's ratio.
Yeah.
Right? But yeah. So the best way, of course, is if you do both.
Yeah.
If you can afford it, of course,
yeah.
right? Which is getting more difficult now with the increased interest rate. Let me have some words on real estate in an international context, right? I mean, we have briefly discussed it in the other video, but if you invest in real estate in another country, then of course you have to look into the double tax treaty where it's taxable. It's usually where the property is located, and then of course according to the respective laws in that country. However, if it's not within the EU, you have to consider it for progression purposes in Germany, which means the income, if it's positive, will influence the German tax rate. And that is a pain. The income determination has to be done according to German law. So, which means with a foreign investment, you have an income determination according, let's say, to UK law and one according to German law, right? So it's a little bit more effort. Rules are similar, right? But like depreciation rate, for example, it might be different, but from the deduction maintenance and so it's basically the same. And then, of course, you have to look into the treaty. If it's really exemption with progression or if it can be taxed in Germany as well, and the foreign tax is credited like we have it with Spain, right? And the same base applies for if you sell that property in the other country, right? It's taxable in the other country, yeah, but then we have to look into the treaty if it has to be included for progression or not.
Right? Okay, which is what we discussed in the other video.
Yeah.
And there's also a lot of videos on YouTube that tell the people that they should form a real estate company and then buy properties with their own real estate company instead of buying them as a private person. What do you think about this from a strictly tax perspective? Is it really tax beneficial as the internet says, and should people do it?
I would not advise to do it. And to be honest, I do not see a tax benefit. I see rather the opposite. Right? I mean, what happens if you have real estate within a GmbH? I mean, there are a lot of entities or real estate entities, but they have a huge portfolio, right? So, and not just one or two or three apartments or houses, right? So, and that is for them, it might be beneficial since it's all combined. So there are special tax treatments if they shift the property within the GmbH or with other companies within their group of entities, right? But for a private person, it's from my point of view always better to have it or be invested as a private person, because if you have it in a GmbH, then first you have to create the GmbH, you have to have the bookkeeping for the GmbH. I mean, you have to do the income determination for the property, and you have the bookkeeping for the GmbH, right? So you have both. Then you have, depending on the size, publication requirements and so on. So you have to pay a lot of attention to run the GmbH appropriately, right? And the second point is, if it's within a GmbH, it's a trade. So which means you have trade tax to consider, to file a trade tax return and so on. And when you sell it, right? So as I said before, if you have it privately owned, after 10 years, it's tax free within the GmbH. I mean, you sell it out of the GmbH, then there's a profit that has to be taxed within the GmbH. And if at some point you liquidate the GmbH, I mean, there's a liquidation profit which you have to tax then at that time, right? So, from my point of view, if we are not talking about huge investments, it's always more beneficial and easier from handling point of view for you to keep it as a private person.
I completely agree.
And you can have 10, 15 apartments, houses as a private person. It doesn't matter. As long as you do not go into trade with them. So if you trade more than 3 estates within a period of 5 years, then you are in a trade, right? Because then it's not private wealth management, then it's a trade. So you have to be careful.
Finanzamt considers you a business then.
Yeah, that's it.
Yeah. I completely agree. Also so you're mentioning it's not tax beneficial to sell it within the GmbH. I think you don't even get a property in a GmbH if you walk into a bank and say, hey, I'm a strictly employed person. I was never self-employed. I have a strictly fresh made GmbH that I founded yesterday. Give me a mortgage for 100,000 euros. It's not going to work. If you're planning in the millions, okay, then this might work, and then you might also get some tax benefits. But if we're talking about buying a property for 100, 200, 300K, keep it private.
Yep.
If people have further tax questions, Dirk, how can you help?
I mean, of course, you have to contact me, right? And then basically what I do is I conduct a Zoom meeting for a quarter of an hour to get to know the person, the requirements, and the topic and the expectations. And then tax advice has a lot to do with trust, right? So both parties, so you and I, have to say, okay, we can work together, right? It does fit, right? And I have the trust in that person, right? And then based then on the information I get from the interview, then I can basically talk about the process, how it works, and of course also about the fees. What does it cost?